Welcome to Breaking News to Trading Moves.
Glad to be here for this one.
Yeah, so imagine showing up to like a high-end real estate auction, all right? You're completely determined to buy the property of your dreams.
Oh, I can picture it. Paddles in the air.
Exactly. And you outbid absolutely everyone in the room. The gavel drops, the place is yours. But the moment you walk through the front door, you realize you spent so much capital winning the auction that you cannot afford to put a single piece of furniture inside.
Yeah, you're totally house poor.
You are house poor.
Mm-hmm.
And that's the exact mission for our time together today with you, the listener. It's incredibly clear. We are taking one specific headline from the financial news cycle, stripping away all the noise, and breaking down exactly who the winners and losers are across the market.
Right, getting right to the core of it.
Right, along with the direct implications for you and your trading strategies. And I mean, that house poor scenario, that is the exact dilemma hanging over the global food delivery landscape right now.
It really is. The central headline driving our analysis today revolves around an impending showdown for a major global asset. So Uber is reportedly weighing whether to raise its offer to acquire Delivery Hero.
Which is a massive move on its own.
Oh, absolutely. And this development comes immediately after Delivery Hero's shareholders actually pushed back on an earlier proposal. Like they were demanding a higher valuation.
You wanted more money, naturally.
Actually, right. But the situation is far more complex than just a simple two-party negotiation, because DoorDash is actively circling this exact same asset.
Wow. Okay, so DoorDash is lurking right there.
Yeah, they're right in the mix. So for traders, this sets up a highly specific dilemma that we need to resolve today. Does acquiring Delivery Hero create a far stronger global platform for the ultimate winner?
Or does it just ruin them?
Exactly. Does this situation trigger an aggressive bidding war that just destroys profit margins and devastates free cash flow?
So let us start with the companies actually stepping up to the auction block, right? The potential bidders. Because staring down a bidding war is, well, it's a double-edged sword. And it puts immense pressure on management's capital allocation.
It's the ultimate test for an executive team.
For sure. Because the cost of winning can often look a lot like losing. Why do Uber, U-B-E-R, and DoorDash, D-A-S-H, find themselves facing such intense scrutiny from investors right now?
Well, investors are fiercely protective of capital, right? And a bidding war creates these immediate flashing red lights around a metric called free cash flow.
Let's define that really quick for everyone.
Yeah, sure. Think of free cash flow as the actual cash left inside the company's war chest after they pay to keep the lights on, compensate their drivers, maintain their servers.
All the operational stuff.
Right, all the baseline costs.
Yeah.
The free cash flow is the money they actually use to pay down debt or, return value to shareholders. So when two giants like Uber, U-B-E-R, and DoorDash, D-A-S-H, start raising their paddles higher and higher to win Delivery Hero, they threaten to completely drain that war chest.
Right, they're just emptying the bank account for the prize.
Exactly. If you drain the cash reserves just to win the prize, the broader market gets incredibly nervous about the financial health of the buyer.
That makes perfect sense. I mean, taking on massive debt to finance a much higher purchase price completely alters the buyer's balance sheet.
It ruins the math for investors.
Right. But even if they secure the funding, right, say they get the money and buy the company, the actual operational reality of absorbing a competitor is rarely smooth. I mean, there's a concept analysts call integration risk. And it seems really vital here.
Oh, integration risk is arguably the most complex hurdle in any major acquisition. Because, you are not just buying a logo.
You're buying the whole messy operation.
Exactly. You are attempting to merge entirely different computer code bases. You are acquiring an independent driver network. You're inheriting thousands of existing merchant contracts.
Which all probably have different terms.
Right. Different terms, different fee structures. And you're attempting to blend competing corporate cultures. Merging all those fragmented systems into a unified, efficient machine requires massive amounts of time and capital.
It's a headache.
A total headache. Consequently, the market is actively questioning whether management teams are simply chasing revenue growth at the wrong price.
Wait, hold on. I follow the logic on why overpaying makes Uber a potential loser here. But if Uber, which is DoorDash's fiercest rival, successfully buys Delivery Hero and creates this, unstoppable global juggernaut.
Yeah.
How can DoorDash possibly sit in the winner's circle? Should DoorDash not be terrified of a larger
I
Uber?
know it sounds counterintuitive, right?
Yeah.
But DoorDash, DASH, actually benefits directly from the market validation this whole thing provides.
Validation. How so?
Well, if investors witness Uber willing to pay top dollar to secure an international footprint, the market kind of collectively decides that global delivery scale is the ultimate priority for this entire sector.
Oh, I see. It proves the thesis.
Yes. And DoorDash has already taken major steps to expand internationally,
Hmm.
most notably after they acquired Wolt, the European delivery platform.
Okay, I see the dynamic. If Uber proves that international platforms are premium strategic assets, it basically validates DoorDash's previous strategy.
Precisely the point. It signals to the broader market that securing a global footprint is the single most valuable metric right now. And if the market applies a higher premium to global logistics platforms, DoorDash's valuation actually rises in tandem with that industry-wide revaluation.
Wow. So they win just by being in the same neighborhood. Okay, so if we follow that logic, right, this idea of logistics platforms becoming highly prized assets, let us look at the grocery sector.
Yeah, let's pivot to grocery.
Because you put Mabel Bear Instacart, C-A-R-T, in the winner's circle. And I want you to explain the mechanics of that. Because why does a company delivering groceries benefit from two tech giants fighting over a company delivering, hot meals?
Right, it seems disconnected at first glance. But it's because the underlying mechanics of grocery delivery, retail media, and marketplace logistics all belong to the exact same macroeconomic trend.
They're using the same roads, basically.
Literally and figuratively, yeah. They are adjacent sectors running on the exact same logistical plumbing. So if a consolidation accelerates in restaurant delivery, the market begins viewing the major players in grocery delivery as highly valuable, scarce assets too.
Because there's only so many networks out there.
Exactly. Maple Bear Instacart, C-A-R-T, commands favorable attention because an acquisition battle over Delivery Hero highlights the immense underlying value of owning the logistics network and, more importantly, owning the direct customer relationship.
All right, the app on your phone. But, the retail media component of Instacart's business model feels crucial to understanding their profitability here. It is not just about the fee they charge to drop off the groceries, is it?
Not at all. I mean, retail media is the true margin driver.
Wait, explain retail media for the listener really quick.
Yes, so when you open an app like Instacart and you search for cereal, right, the very first result you see is often a sponsored placement by a major brand, like Kellogg's or General Mills.
Right, it has a little sponsor tag on it.
Exactly. That brand pays Instacart for that premium digital shelf space. Selling advertising space within their own app is an incredibly high-margin business.
Way higher than the delivery fees.
Oh, way higher.
Yeah.
It's wildly more profitable compared to the physical, labor-intensive act of actually paying couriers to drive around a city in traffic.
Right.
So Instacart, C-A-R-T, wins because they control both things. They have the lucrative retail media space and the highly sought-after local delivery network.
Which provides a perfect pivot to the traditional retail landscape. Because if a platform like Uber expands its global delivery network and achieves this massive density we're talking about, they will inevitably expand their battleground.
They have to. They'll run out of room in just restaurants.
Exactly. Once a driver is on your street delivering a burger, the marginal cost of having them also deliver a gallon of milk or, paper towels is very low.
Almost zero.
Right. So how do the legacy retail giants defend their turf against an encroaching food delivery app?
Well, they're forced into a defensive posture, which is why we must categorize the large retailers as potential losers in this specific consolidation scenario.
The big guys are losing.
Yeah, the companies facing the most pressure here are Walmart, WMT, Amazon, AMZN, and Kroger KR.
But wait, Walmart, WMT, and Amazon AMZN are absolute behemoths. I mean, they have virtually unlimited resources. How does an Uber acquisition directly threaten their return on investment?
It comes down to the billions of dollars these retailers have already committed to building their own proprietary delivery infrastructure.
Oh, they've already spent the money.
Massive amounts of it. Walmart, Amazon, and Kroger are currently investing heavily in same-day delivery capabilities. They are building out massive localized marketplace services and really pushing these membership-based logistics models.
Like Prime and Walmart Plus.
Exactly. You subscribe to Amazon Prime or Walmart Plus specifically because you want the rapid delivery of everyday goods.
Okay, I see. And if Uber successfully scales up a highly efficient global network, They become a much faster, more aggressive competitor in the convenience and local commerce space.
Correct. I mean, Uber already commands the fleet of drivers navigating the neighborhoods. They are already out there. If they achieve greater scale and density through an acquisition, they can easily pivot those drivers from restaurants to convenience stores and local grocers.
Just flip a switch in the app.
Right. And that direct high-speed competition threatens the returns Walmart, Amazon, and Kroger expect to generate from their own massive logistics investments.
Ouch. So if the big box retailers are building these fortified walls to protect their grocery turf, the pressure inevitably flows down the supply chain to the entities actually creating the food, right?
Yeah, it rolls downhill. Yeah.
So let us examine the restaurant divide, because if the delivery platforms shrink down to just a few massive consolidated players, it completely rewrites the rules of engagement for the businesses relying on them to reach you, the consumer.
It totally changes the game. And the defining factor for the restaurants here is bargaining power.
Leverage.
Leverage, exactly. The ability to dictate terms completely separates the winners from the losers in this category.
Okay, let us frame this with an analogy. Think about a sprawling retail shopping mall, right?
Yeah.
The massive anchor tenant and
Yeah.
the giant department store on the end, they pay almost nothing in rent because the mall owner knows that department store drives all the foot traffic.
Right, the mall needs them more than they need the mall.
Exactly. The mall desperately needs them. But the tiny independent boutique down the hall, they pay an absolute fortune per square foot because they have zero leverage.
Yep.
So does that same dynamic apply to how restaurant chains negotiate with platforms like DoorDash or Uber Eats?
That perfectly illustrates the mechanics of the relationship. It's spot on. The winners here are the massive global chains acting as the anchor tenants. We are looking at McDonald's, MCD, Yum Brands, YUM, Chipotle, CMG, and Domino's Pizza, DPZ.
Okay, so explain how a McDonald's, MCD, or a Domino's, DPZ, utilizes their scale to protect their profit margins from these delivery apps.
Well, these large chains boast incredibly strong digital ordering demand on their own. Consumers actively open the apps specifically searching for them.
They type in Chipotle directly.
Right. And because they command millions of daily orders and drive immense traffic to the platforms, they possess the bargaining power to manage their costs. They can actually sit across the negotiating table from a consolidated delivery giant and just cap the commission fees they pay.
They just refuse to pay the standard rate.
Exactly. Furthermore, they can dictate the terms regarding how much they're willing to spend on promotions.
Because if the delivery platform refuses their terms, the large chain could simply remove their menu from the app, which instantly evaporates a massive chunk of the platform's daily revenue.
It would be a disaster for the app. The platform needs the volume that Yum Brands, YUM, or Chipotle, CMG, provides just to keep your drivers busy. Therefore, if Uber and DoorDash compete harder to build a larger ecosystem, these major restaurant brands actually benefit.
So they win by just being huge.
Pretty much. They receive more platform spending directed toward their visibility, they achieve better delivery reach, and they capture stronger consumer demand, all while relying on their negotiated lower fee structures to protect their profitability.
Wow. Okay, so compare that leverage to the boutique shops in our mall analogy. What happens to the smaller chains if the industry consolidates and the platforms gain ultimate pricing power?
The outcome is severe margin pressure. The losers in this scenario are the smaller or, highly delivery-sensitive chains. This includes Papa John's, PZZA, Wingstop, WING, Sweetgreen, SG, and Cava, CAVA.
Okay, let us detail the actual costs a company like Sweetgreen, SG, or Cava, CAVA, faces. Why does platform consolidation hurt them directly?
Well, delivery inherently increases the total volume of orders moving through a kitchen, sure, but it heavily taxes the profit margins. A restaurant has to absorb baseline commission costs for every single item sold.
Right, the app takes a cut of the burrito.
Exactly. Additionally, to avoid being buried on the 10th page of the app's search results, they are required to allocate heavy promotional spending. They have to buy ads on the app.
Oh, man. So if Uber buys Delivery Hero or the ecosystem broadly shrinks to fewer platforms, the remaining delivery giants gain tremendous pricing power.
Absolutely.
Because fewer platforms mean fewer alternatives. A consolidated giant can simply mandate higher commission rates, and a mid-sized chain has very little leverage to push back.
They are totally trapped. They either accept the rising fees, which eats directly into the profitability of every meal they sell, or they risk losing a vital revenue stream by abandoning the delivery app entirely.
And they can't just hike their own prices forever.
No, exactly. The restaurants cannot easily pass a 30% commission fee on to the consumer by raising menu prices without scaring away the customer. I mean, nobody wants to pay $30 for a salad, so their margins are squeezed aggressively from both sides.
Which guides us naturally to the final category we need to examine today. Because behind the complex negotiations, the driver networks, the digital menus, there is an entire unseen digital infrastructure processing the actual transactions.
So plumbing.
The plumbing. Think of a kitchen during a dinner rush, right? If a restaurant is taking orders from walk-in customers, the drive-through window, and 3 different delivery apps simultaneously.
It's chaos.
It is chaos. They need a central nervous system to process all those signals so the kitchen staff does not literally collapse. And in this digital commerce ecosystem, the back-end software providers and payment processors act as that nervous system.
Yeah, a larger, more consolidated delivery ecosystem naturally drives a higher volume of online ordering across the entire food and beverage sector. To handle that influx of digital tickets without failing, merchants are basically forced to adopt dedicated, specialized technology.
Right, so who are the specific beneficiaries providing this central nervous system? It's like selling shovels during a gold rush.
That's the perfect way to look at it. And Toast, T-O-S-T, is a prime example of a winner in the restaurant software space. They provide the actual hardware and software that manages the kitchen.
Like those screens you see when you walk into a cafe.
Exactly. When a restaurant needs a point-of-sale system that can seamlessly aggregate orders from multiple different delivery apps, organize the kitchen tickets efficiently, and process the payments, they rely on platforms like Toast. As the delivery volume scales up globally, a restaurant's reliance on Toast's hardware becomes absolutely non-negotiable.
So Toast, T-O-S-T, profits directly from the operational complexity that delivery creates for the merchants.
They solve the headache.
Right. What about the broader payment processors?
Well, for the broader digital commerce activity, the winners are Block, SQ, and PayPal, PYPL.
Okay, detail the mechanics for Block, SQ, and PayPal, PYPL, because they are not managing kitchen tickets, right?
Yeah.
So how do they capitalize on a delivery bidding war?
It's simple. They facilitate the actual movement of capital. As consumer habits become thoroughly entrenched in digital ordering, the total volume of digital commerce activities scales up.
More swiping, more tapping.
Right. And these payment processors take a tiny fraction of a cent, or a very small percentage, of every single transaction that occurs. They operate a pure volume game. Yeah, as the delivery giants battle for supremacy and drive billions of dollars in sales through their digital channels, companies like Block and PayPal benefit from the sheer massive increase in total transaction volume.
So they operate completely agnostically.
It's total neutrality.
They do not care if Uber or DoorDash ultimately wins the bidding war for Delivery Hero. They only care that billions of dollars are flowing across digital networks and that their infrastructure is processing the payments.
Exactly. They are pure infrastructure plays. They profit from the overall adoption of digital commerce technology, regardless of which specific delivery brand's logo is printed on the bag arriving at your front door.
That is brilliant. Well, we have traveled across an expansive ecosystem today, all stemming from a single headline about Uber weighing a higher bid for Delivery Hero. Let us briefly summarize the forces at play here.
Sure. We began with the immediate capital allocation dilemma facing the bidders. Uber, U-B-E-R, and DoorDash, D-A-S-H, face investor scrutiny because an aggressive bidding war threatens to drain free cash flow and introduces severe integration risks.
But DoorDash had a silver lining.
Right. DoorDash, D-A-S-H, alongside grocery platforms like Instacart, C-A-R-T, stand to win if the market assigns a higher strategic premium to global delivery scale and high-margin retail media networks.
And from there, we examined the defensive posture of the retail giants. Walmart, WMT, Amazon, AMZN, and Kroger, KR represent the potential losers in this setup.
Yeah, their massive capital investments in same-day delivery face a direct, localized threat from a powerful, globally consolidated delivery network encroaching on the convenience and grocery sectors.
Right, on their home turf. Then we explored the restaurant divide, focusing entirely on the mechanics of bargaining power. The massive chains acting as anchor tenants, McDonald's, MCD, Yum Brands, YUM, Chipotle, CMG, and Domino's, DPZ, are the clear winners. They possess the volume to negotiate lower fees and protect their margins.
And conversely, the smaller or delivery-sensitive chains Papa John's, PZZA, Wingstop, WING, Sweet Green, SG, and Cava, CAVA, they face severe margin pressure if a consolidated platform flexes its ultimate pricing power.
Finally, We analyzed the back-end tech beneficiaries acting as the central nervous system for the sector. Toast, TOST, Block, SQ, and PayPal, PYPL, all stand to win as the broader delivery ecosystem mandates more restaurant software adoption and drives an ever-increasing volume of digital payment processing.
It really is crazy how interconnected delivery, retail, restaurants, and technology are. A single acquisition headline directly impacts the margins and the strategies of every single link in that chain.
It's all tied together.
It is. And as we monitor how this potential consolidation resolves, I want to leave you with a final thought to consider regarding the restaurant divide. We discussed the intense margin pressure facing smaller restaurants if delivery platforms gain unchecked pricing power.
Right.
So if this consolidation continues and platforms dictate terms entirely to the smaller, independent, or mid-sized chains,
Hmm.
how might that dictate the variety and the actual cost of the food available to you on these apps in the future?
That's a scary thought.
Right. Will you eventually only see the giant chains that possess the leverage to afford the fees, while the smaller, local options just vanish from your screen entirely or become prohibitively expensive to order?
Wow. That potential outcome is the real consequence we will all have to watch out for as consumers. Thank you for joining us to break down the winners, the losers, and the mechanics behind the headlines. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.